All right, welcome back. Hopefully we will finish up module one, chapter one in this video. We're just gonna have to work our way through it to see where we get. So this was a slide that I had made up. It's not from Pearson. I just made this one up to give you a visual representation of what's happening with the various taxing types. So here we got C corporation, S corporation, partnership. Net income is $100,000 for all three. C corporation is going to be the only one that actually has a separate tax. Um, Takeaway income, income after taxes, whatever you kind of want to call that. You can see that, okay, so right off the top, they're paying 21 grand in tax. So their after tax income, 79,000, 100,000 for S corps and partnerships because they don't pay tax at the entity level. Dividends declared. S corporations and partnerships have something similar, but it's not dividends. It's distributions, either shareholder distributions for S corporation, partner distributions, partnerships. Pass through to the taxpayer. So you can see corporation, I've got nothing in there. Here are our pass through entity types. So the income will flow from the entity to the shareholder, taxpayer, partner, whatever terminology you want to get it. And then that gets taxed at the taxpayer's tax rate. So you can see in the C corporation, the 79,000 is going to be, see if it can be short-term or long-term investment income. S corporation partnerships, it gets taxed at the taxpayer's marginal tax rate. Now looking at tax-paying entities, S corporations, basis, shareholders basis, S corporation stock is calculated in the partnership interest. It's money in, it's plus net income, less losses, less any distributions outside of that. It's very easy, and when you see in practice, where it gets confusing is you have to go back and but if you're doing it on a year-to-year basis, it's pretty easy. Whatever they put in, plus whatever their share of income for the year, less any distribution they take. LLCs, limited liability companies. LLC can be treated like a partnership for tax purposes. LLC is more of a legal definition than it is a tax definition. You can have sole proprietorships, you can have partnerships, you can have S corporations that aren't LLCs. LLC, it's a veil. It's just say, hey, after this, you can't come after anything in mine personally. If I have my house and my car, and let's just say a boat, let's say I've got a highly valued stock of, let's say, Pokemon cards, right? These things, I could sell them and retire forever. I keep them in my safe. Um, if I'm running my business and I do something so horrendous that this third party or a client or customer is injured beyond belief. Without that LLC designation, they could come after those Pokemon cards. They could come after my house. They could come after my vehicle. With that LLC, it says, hey, you know what? The buck stops you. It's you get everything that this LLC is, under this umbrella, but you can't come after me first. What else we got here? LLCs that are like partnership, file 1065, not different than any other partnership. If it's corporation, 1120, not different than any other corporation. Single member LLCs are disregarded for tax purposes. You'll probably see that term a lot, disregarded for tax purposes. It means that it doesn't have a separate tax filing to report. It gets reported on the individual's 1040. LLP, it's a limited liability partnership, similar to LLC, it's just that it's partners. Trusts can be taxed either on entity level or flow through. Generally, trust tax on income not distributed to beneficiaries. Files a separate form 1041. Trust marginal tax rates go to the highest levels far more quickly than individual level. That I do want to draw attention to because that's the big thing kind of with trusts is that it doesn't take a lot until they're at that top bracket. I want to say it's somewhere in the 20 to 30,000 range, until they're paying the highest tax rate. Tax law sources. So we've got legislative, that's going to be the IRC, congressional committee reports, executive, treasury regulations, revenue rulings, revenue procedures, private letter rulings. Those last three are going to be related to individuals trying to get some insight as to how the IRS might view a complicated tax situation. You might request a private letter ruling to say, hey, you know what, I've got this weird situation. How would you guys treat this? And people will use that as a source of information to say, like, okay, it's okay if I treat this situation like this, or if I treat it like that. Judicial court decisions, judicial doctrines, legislative process. So you've got a tax bill. The House Ways and Means Committee holds hearings with public, Treasury Secretary, IRS Commissioner. If it gets rejected, that bill dies. If it gets approved, then it goes to the House, and then it goes to the Senate Finance Holds hearing. I would print out. I'm not going to go through all of these steps, but it's good to, I would say, print this out, kind of understand how it starts, where it goes at each steps, when it can die. There's a lot of steps to it. I don't want to go through all of this. If you understand the general concept, you'll be fine. Organization of the IRS. So you can see we've got a pyramid structure here. We've got auditors, tax service centers, various divisions, the IRS Commissioner National Office. I'm not going to spend too much time on this slide. You can print this off. This is just all kind of informational. Audits. There are various forms of audits. I will often hear people say like, oh, I got audited. And really it's basically the IRS saying, hey, we have this form, let's say this 1099 that we received, and it reported $1,000 of income to you. You either reported it differently, and we're changing it to what this form says it is, the thousand. People will think that they're being audited, and that is technically an audit. It's called a correspondence audit. Basically, the IRS has their equipment, their machinery that says, okay, we know that client A, taxpayer A, received this $1,000 in a 1099. And when client A, taxpayer A, their tax return comes in, they're going to match that. It's called the matching principle. They're going to look at that tax return and they're going to say, did they report that $1,000 of income? If they did, perfect, everything's gravy. If they didn't, they'll send a letter to say, hey, you didn't report this, so we're reporting it for you. Here is the additional tax, and then any interest and penalties that would go along with that. Correspondence or letter audits, automated letters. Yeah, that's just what I kind of gone through. I probably should have read the slide first before commenting on it. In-person audits, taxpayer will work with the IRS agents, either at IRS office or taxpayer's place of business. There you would either, if you went to the IRS office, you would bring whatever documentation you're requesting. Statute of limitations, absent fraud, IRS can audit return for the later of 3 years from the date the return was due or was filed or the due date. Extensions kind of play into that. And the absent fraud is a big part of it. If I were to commit tax fraud today, 15 years from now, they'd be able to go back and look at that. That 3 years means nothing to them because it's fraud related. They can go back for as long as they want to, as long as they need to. Longer statute of limitations if fraud or understatement of more than 25% of gross income. Penalties. So there's going to be two major penalties you're going to learn about: failure to file, failure to pay. Failure to file a return is required. The failure to file is 10 times greater than the failure to pay. So even if you can't pay, let's say I fill out my tax return and I send it in, it's, oh man, I owe $10,000. Um, I should still send in that tax return. I should not say, you know what, I can't afford to pay this. I'm not going to fill it out so they don't know. They will find out. They will assess me penalties and interest off of the failure to file, which is 10 times greater. It's in your best interest to file, even if you can't pay. Um, Interest and penalties are assessed on tax liabilities that were not timely paid, failure to file 5% up to 25%, failure to pay 1/2 of 1%. That's where that 10 times greater comes in. Half of a percent versus 5%. Um, Even if you can't pay, it is your best interest to file because you don't want that failure to file penalty. Interest and penalties, again, continue 20% accuracy related penalties, 75% penalty for fraud. Components of tax practice, tax compliance, and this is probably where, if you go into tax, where you probably start out. Making sure taxes are done right. You're kind of doing the legwork. You're saying, you know what, here's a client's W-2, and this is how much withholding they have. Therefore, here is their tax liability based off of their tax bracket, marginal tax rate. Tax research, helping find some law. That's when you start to get a little more into it. You start researching some tax cases. A client wants to take a certain position on a tax topic. It's making sure that that topic that stance, one, is reasonable and valid and can be argued, and two, finding cases to support that. Tax planning consulting, um, helping clients minimize tax by planning ahead. This is a very popular one, especially, the kind of what I start doing in December. Um, you start meeting with people saying, hey, what's this year going to look like? You've got a business owner who cleared $1 million in income. Maybe they need to purchase a work vehicle and drop that $1 million in income down. Financial planning and helping clients plan for cash growth, for flows, growth, financing. And that is what we have for chapter 1. But this is going to be more of a boring topic. It's kind of laying the groundwork, but you did it, you made it, you understand penalties, you understand gross income, exclusions, various tax types, and yeah, then we will move on to chapter 2, which I promise it's going to start getting more interesting. This first part, it's all kind of definitions and understanding tax structures, and it's not that interesting. It lays the groundwork, but the stuff coming up will be much more interesting, I promise. All right, thank you for watching, and yeah, let's keep moving on.